Hello everyone, I am Kyle Luga, and me and my groupmates are tasked to discuss about the financial analysis and accounting basics. So before we proceed, I would like to ask you, who runs the world? Girls? No, it's not the girls, it's not the boys, even the government and terrorists, but being practical, it's not even God. The one who runs the world is money. Yes, money. Because if you really want something, if you really want to go somewhere, or if you want to achieve something, you really need money to achieve them. Even in our daily living, we really need money in order for us to survive. So every venture needs capital or money to start, operate, maintain itself, and grow. So money, preferably in the form of cash, because it is the one who fuels the venture. So to be successful, a venture must take in more cash than it needs to operate. That cash must be generated via sales or from an external investors or lenders. Business need money to purchase or lease equipment, build up inventory, and pay the utilities, employee wages, taxes, and rent. Without cash, a business cannot survive. A well-funded venture can be unprofitable for a while until it builds a customer base and moves toward profitability. However, without the cash needed to pay its creditors, employees, and others, it cannot last very long at all. So no venture, no matter how large or how small it is isolated from the need of sound financial management. Often, when firms get too large and lose track of important details of their day-to-day financial condition, they encounter problems that may take months or even years to fix, and some cannot be fixed at all. So the bankruptcy of the large financial firms such as example, the Bear Stearns, Lehman Brothers, and AIG during the credit crisis of 2008 is placed a new emphasis on financial control and reporting. So in this chapter, we define accounting and finance and describe the role of the accountant and the financial manager through launching, operating, and growing a technology venture. So now, let's start the definition and practices of accounting. So busy entrepreneurs and aggressive business people sometimes deride accounting as being little more than bean counting. However, most successful entrepreneurs and people in the business community will attest that a basic understanding of accounting principles is an essential entrepreneurial tool. In a word, accounting is the language of business. Anyone who aspires to launch and operate a technology venture must to some degree speak the language of accounting. So business run on their numbers, and accounting plays an important role in recording and validating the numbers that drive business decisions. So the American Accounting Association, or AAA, defines accounting as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of information. So accounting can be divided into two categories: financial accounting and managerial accounting. So these types of accounting differ primarily by virtue of the people they are designed to serve. So first is the financial accounting. It is intended primarily for use by external decision makers such as investors, creditors, and the Internal Revenue Service. However, the managerial accounting is mainly used by internal decision makers such as company managers. So, in this chapter, we will be concerned primarily with financial accounting. So accounting information is useful to a ventures managers, investors, creditors, advisors, and others. So the ventures managers are the most frequent users of its accounting information. So they must have a reliable information to make decisions about allocating resources, cutting expenses, and investing in growth. Entrepreneurial managers also use accounting information to assess the consequences of alternative business strategies. In addition, accounting information can be used to compare actual financial results with expectations. Now, let's discuss the accounting cycle. So, a primary, a primary purpose of accounting is to communicate the results of business transactions. So the accounting cycle is a sequence of 6 steps used to track of what has happened in business and to report the financial effect of those events. So the first step is obtain data from business activities. So the accountant first analyzes business transactions to determine which should be recorded and at what amount. Typically, accountants record only transactions that can be measured and verified with some degree of precision. For example, purchase of a truck for making deliveries to customers can be accurately measured and easily verified. However, an event like the resignation of key employee, also a business transaction, would not be recorded. Although such an event may represent an economic loss to a company, it is difficult to determine accurately what the amount of the loss would be. So the second step would be record transactions in accounts. So accounting transactions are recorded chronologically in a journal. A journal may be either a book or a manual accounting system or an electronic file in a computerized accounting system. So each entry contains the date of the transaction, its description, the debit and credit columns. So transactions are recorded in the firm's general journal or in specialized journals. A general journal is a book or a file in which transactions are recorded in the order they occur. As a business expands, they may adopt specialized journals to record particular types of business transactions. For example, the credit sales or capital expenditures. So let's proceed to the step 3, the update account balances. So business needs to know the balances of various financial statement elements, like as assets, liabilities, owner's equity, revenues, and expenses at any point in time. So accounts are used to summarize all transactions that affect a particular financial statement component. So a business maintains separate accounts for each of its assets, liabilities, equities, revenues, and expenses. All transactions affecting in one account are posted or recorded from the journal or specialized journals to the account. All the accounts of a business are summarized in general ledger. That's why the next step will come to make end of period adjustment. So with the previous step, we can now make the adjustment needed for the future plan of the the income and outcome or outflow of the money we needed. And now the final steps of the accounting process: prepare financial statements and close the books. So the final steps of the accounting process involve preparing financial statements. So financial statements present a company's financial position, results of operations, and flow of cash during a particular period of time. So the financial statements that are prepared include the income statement, balance sheet, and statement of cash flows. They can be prepared for any time interval like daily, weekly or monthly, but they are always prepared annually according to the venture's fiscal year. So investors, creditors, company managers, and other interested in a firm's financial position all rely heavily on financial statements. In preparing these statements, accountants check the balance sheet to determine whether their entries balance. If not, adjustments are made to how the numbers have been entered until a balance is achieved and the books can be closed. So now let's discuss the accounting equation. So the accounting equation indicates a company's financial position at any point in time. So on its framework rests the entire accounting process. According to the accounting equation, a company's asset is equal to its liabilities plus owner's equity. Thus, any recorded business transaction can be analyzed in terms of its effect on the accounting equation. Also, transaction must be recorded to maintain the equality of this equation. So this equality is reflected on the balance sheet, one of the financial statements a firm is required to prepare. So these are some terms and concepts that businesses use to keep records. So below you can see the first one, assets are anything of value owned by the business and used in conducting its operations. So example, include cash, investments, inventory, accounts receivable, and furniture and fixtures. The second one is liabilities are debts owed by the business to its creditors, including obligations to perform services in the future. Liabilities include accounts payable and notes payable. Example, when a firm uses credit or to purchase machinery, wages payable to employees, and taxes payable. The next one is the owner's equity, represents the claims of the owners against the firm's assets. The next one is revenues. Revenues are inflows of assets resulting from the ongoing operation of a business. So business generate revenues by sales of goods and services, in interest earned in investments, rents, royalties, and dividends. The last one is the expenses. So expenses are costs incurred to produce revenues. So expenses include the cost of goods sold, like the goods or services that the firm used to generate revenues, salaries, utilities, taxes, marketing, and interest payments. Revenues and expenses are components of owner's equity. So revenues result in an increase while expenses result in decrease in owner's equity. So net income, or the bottom line, is the excess of revenues over expenses. That's why investors, creditors, and company managers closely watch net income, a chief barometer of business performance. So that's why working with accountants, it's a must when you are going to build your business, so someone will be guided, or your business will be guided on its right path until your business lasts. So that's all for me, and my groupmate will continue.
Hello everyone, I am Jericho Kalaman and I am going to discuss about the finance. So if we want to make a business, we need sufficient supply of cash to operate. So kaning sufficient supply of cash to operate, mon siya ang capital. So if wala kay capital or wala kay cash para sa pag-operate, dili maging possible ang business kay need yun nato ang capital. So again, if you are going to make a business, we are also considering taking risk in the hope of profit. So again, dili always na successful ang atong business. So naay times na maka-experience ta og failure. So, if you want to make a business, entrepreneur needs to determine venture cash needs for both the short term and the long term. So, if ma-determine na nato ang venture cash needed for both short term and long term, entrepreneurs should find sources to provide the necessary cash. So, asa man ta kuha o asa man ta mo gikan anang sources na maka-provide sa atong necessary cash. So, diri mo sulod si finance. So, business needs finance. So, what is finance? As a discipline within the business school, finance is the study of how to manage money, either from a personal perspective or from a business perspective. So, we are talking about the business perspective here. So within the business, finance is the functional area charged with locating and acquiring capital for the business, managing capital in a disciplined manner, and determining the best uses of capital given the strategies and goals of the venture. So, kinsa man ang responsible ani? So, mo siya si the financial manager. So, unsa man si financial manager? So, financial manager is the individual responsible for the venture's finance function. So, mo to yung gani ka na mo siya ang responsible ani. So, large firms use the title of Chief Financial Officer or CFO to refer to the person in charge of a firm's financial affairs. So, although many entrepreneurial ventures do not formally appoint a financial manager, but the financial management task must still be performed. Although daghan yung mga entrepreneurial ventures na dili sila magkuha og financial manager, but it doesn't mean na dili na i-perform ang financial management kay this is really needed sa business. So these are the tasks assigned to the person responsible for financial management. First is the business plan development. Next is the risk management and insurance, benefits and compensation, equipment leasing and financing, facility and real estate needs analysis, budget development, expansion planning, cash flow management, owner of compensation planning, commercial real estate financing and planning, financial system design and implementation, business sale preparation, and tax planning. So next is the financial plan. So what is financial plan? A financial plan is simply an overview of your current business, financials, and projections for growth. So it will help you set realistic expectations regarding the success of your business. You're less likely to be surprised by your current financial state and more prepared to manage a crisis or incredible growth simply because you know your financial inside and out. So another advantage of this is also makes you more attractive to investors. Why? Because it makes you less of a risk and show that you have a firm plan and track record in place to grow your business. So, di ba? If ikaw ang investor, so, ay mo yung piliun nga company nga imong i-investan is less risky. So, by the help of financial plan, murag ma-attract nimo ang investor because murag imong business is less risk because sa financial plan. And next, a sound financial plan will minimally require the following tasks to be performed. So, these are the estimate month-by-month flow of funds out of the venture, compare monthly inflows to monthly outflows. If excess funds exist, Plan how to use these funds for growth or investing. Next is if funds are short, adjust inflows or outflows and or look for other sources of funding. Next is if other funding sources are needed, analyze alternative to find the most efficient source. And lastly, establish a system routinely to monitor and evaluate the result of this process. So this is the end of my discussion. Thank you for listening.
Hi guys, good day. I am Jim Giver and today I'll report about the topic financial statements. So, when we say financial statements, these are the reports that provide the detail of the entity's financial information including assets, liabilities, equities, incomes and expenses, shareholders' contribution, cash flow, and other related information during the period of time. So, financial statements are also often referred to as pro forma financial statements. So, financial statements compose of the four basic financial statements which are the sales forecast, the income statement, the cash flow statement, and the balance sheet. So, let's discuss the four basic financial statements one by one. So, first is the sales forecast. Sales forecast is the primary tool for estimating a venture's cash inflows from selling activities. So, it is the information of the various financial statements that entrepreneurs use to project their venture's financial performance into the future. Also, it is the foundational for the pro forma financial projections because the numbers reflected here flow automatically to the other financial statements. And this sales forecast has have also the basic components, which are the units of sale and pricing for each of the various units, volume of sales for each unit in each accounting period, and the variance in sales volume between accounting periods due to exigencies. So, total or gross sales. So, it means that this line will be carried to the top line of the income statement or revenue without change. So, the example of a sales forecast. As you can see, year 1 composed of 12 months. So, the data are as follows in month 1 until month 12. So, this is the example of the sales forecast. Next is income statement. Income statement operating costs are usually referred to as expenses for a venture are projected or recorded on what is referred to as the income statement. Next is it reports the gross sales of the venture as revenue on its top line. So all the expenses associated with operating the venture are recorded and subtracted from the revenue in each accounting period, so monthly and annually, to generate bottom lines profit or losses. So, for example, this is the example of the income statement. The based on the year 1 and the data are also as follows from month 1 to month 12. So as you can see the data, so this is again the example of income statement. So next is the cash flow statement. Cash flow statement shows the flow of cash into the and out of a business during a period of time. You may have heard the expression that to the entrepreneur, cash is king. So next is this statement also highlights the difference between cash and profits. Next is it monitors the inflow and outflow of cash from the ventures operating in investing and financial activities. So for example, cash flow statement template. As you can see again from year 1 composed of from month 1 to month 12. So the data are also as follows. The cash flow from operations, net cash from operations, and so on and so forth. Next is the balance sheet. Balance sheet lists everything a company owns and everything it owes at a specific moment in time. It shows where all the venture's money has come from, sources of capital, and what it has been used for. Also, in the end, a balance sheet must balance because all of the sources of money to the venture must equal to the uses of that money. So, the balance sheet has two sides. One lists all the venture's assets, or what it owns, and the second one is the other lists its liabilities and equity, or what it owes. So, the basic equation that represents the balance sheet is assets equals liabilities plus equity. So, for example, as you can see on the left side, these are all the assets. The cash, accounts receivable, inventory, current assets, fixed assets, gross accumulated, depreciation, and net. So, all in all, total assets is equal to $9,000. Also, the liabilities, the account payable, accruals, current liabilities, long-term debt, equity, total capital. So if we sum all the liabilities, it has also the total of $9,000. So as you can see, this is what we call the balance sheet because the assets and the liabilities must be equal. So in conclusion, these four basic financial statements is very important in the future of our business. So if we fail to attain this, attain even one of these financial statements, our business might be in danger, and we don't know if it will happen or it will survive for the long run in the industry. So that's all. Thank you.
Good day, everyone. My name is Beth Limarba, and today I will be talking about the financial statement analysis. Wait. So, financial statement analysis is the process of analyzing a company's financial statement for decision-making purposes. It compares accounting information to make the data more useful or practical. So, from the previous reporters of this topic, we have understood how important data gathering is. So, from the data we have gathered, we need to next, diba, analyze. So it is very important to analyze the financial statement analysis. It is because, diba, on decision making, for let's take for example, if your business or venture will be successful in this industry or not. So we have to determine that, and we will understand it in a further discussion. So here we discuss the two of the primary techniques where entrepreneur or financial managers use to analyze their venture's financial statements. Sige, first is the break-even analysis. So break-even analysis has two components, wherein the profit break-even and the cash break-even. So first we will talk about the profit break-even. So what is a profit break-even? Profit break-even occurs when the venture sells enough of its goods and services to cover only its operating costs. So it is calculated using the income statement. On the other hand, cash break-even occurs when the venture is able to collect sufficient cash from sales or its good to cover all of its outgoing cash payments, and it is calculated using the cash flow statement. So as what you have understand and what I have said, the difference between the two is that the profit break-even only covers what its operating cost of the business. On the other hand, cash break-even covers all of its outgoing cash payments. So that is the main difference between the two. And that the cash flow break-even point for a venture generally occurs after the profit break-even, and sometimes it may take many months after. So from this data, So for us to have but to better understand where the break-even point occurs, this red line is what we call the total cost line. Green is the revenue, and this violet color line is profit. So in the place where total cost and revenue intersect is what we call the break even profit break even. It is because it only covers what the operating cost of a business. And it is said also in my report a while ago that the cash break even happens after the profit break even. So from this figure, we can see that the profit break even happens when the company or venture generates $25,000. So yeah. So next is the ratio analysis. Diba there are two ano man, I mean two primary techniques where entrepreneurial financial manager uses in determining the venture's financial statements. The first is the break-even analysis. Next one is the ratio analysis. So it examines the logical relationship between various financial statement items. And ratios are very important to investors and other stakeholders in evaluating the financial health of a venture. It is because it determines the venture's financial standing. So, ratio analysis examines okay, it examines logical and also comparing company ratios to industry and standards can indicate areas in which the company is successful and those in which the company is below standard. So it is important to note that different industries have distinct standards for ratio adequacy. So it simply means that um, what is an adequate for a company in one industry may not be adequate in another industry. So di ba lahi-lahi margin na depende sa pag manage depende sa isa ka industry on sa jud ang ilang or sector. So there are different types of ratio analysis. Four basic type of ratio analysis commonly wherein it is commonly used to determine the financial health of a venture. First is the liquidity ratio. Second is activity ratio. Third is profitability ratios. And lastly, the debt ratios. And we will gonna talk about each of this. First is the liquidity ratio. So it is a measure of how quickly an asset can be converted to cash. So it is the ability of a firm to pay short-term debts as they come due. And there are two commonly liquidity ratios, and these are the current ratio and the quick ratio. So from current ratio is expressed by the formula current asset over current liabilities. It is known as the firm's ability to pay its current liabilities over the current assets. Simply, it is the ratio wherein it shows the strength of a company's working capital. On the other hand, quick ratio, or it is also called as the asset-fast ratio, wherein it is expressed by the formula quick ratio is equal to quick assets over current liabilities, wherein cash or those assets the firm expects to convert to cash in the near future. So from the definition, diba, we can see that ang quick ratio is further ano pa siya, what the company expects to convert into cash in the near future. Well, on the other hand, current ratio is the company's working capital. So, ano yung difference niya? Like, current ratio is from the word current. So, what the company experiences. On the other hand, quick ratio is what the company perceives. That is okay. Next is the activity ratio. So this ratio indicates how efficient a firm uses its resources. It is also wherein a common activity ratio or the account receivable turnover is commonly used. So it is the number of times per year that the average accounts receivable is turned over is collected. So it is a type, simply saying that it is a type of financial metric that indicates how efficient a company is leveraging the assets on its balance sheet to generate revenues and cash. So it is expressed in the formula accounts receivable or turnover is equal to net sales over average net accounts receivable. So next one is the profitability ratio. So it is a company's overall operating success. It is uh, it's the financial performance is measured by profitability ratios. So these ratios measure a firm's success in terms of earnings compared with sales or investment. So over time, these ratios can indicate how successful or unsuccessful successfully management operates the business. Okay, that's what it is stated in there. It is simply the performance of the management. So there are two common profitability ratios, and these are return on sales and return on equity or ROE. So return on sales is expressed in the formula net income over net sales. So unsay ato ang ma-realize in a certain in this equation. Di ba net income and net sales is both an income statements. So it measures the firm's profitability by comparing net income and net sales, which are both statement items, income statement items. On the other hand, return on equity or ROE is expressed in the formula return on equity is equal to net income over equity. So it measures the return that the company earns on every dollar shareholders investment. Investors are very interested in this ratio because it indicates how well their investment is doing in their company. So if you are a shareholder, di ba, you wanted to know how your money is doing in a certain company. If galago ba, yung mga kwarta or lastly is the debt ratio. It is where the companies measure their ability to pay long-term debts by debt ratio. So the difference from the liquidity ratio, and liquidity ratio is short-term debt ratio. Debt ratio is long-term debts. So these ratios try to answer questions such as first, is the company financed mainly by debt or equity? And two, does the company make enough to pay the interest on its loan or due? So diba from the following questions, what have you observed? Diba it is what the potential investors or lenders wanted to ask in a certain company. So these questions can be answered by debt to equity ratio in times interest earned ratio. So debt to equity ratio is expressed in a formula, total debt over equity, wherein it demonstrates the risk incurred by the owners of the firm. So it is said that the higher the debt to equity is, the greater the chance that the firm will be unable to meet its obligation. On the other hand, if gamay po na siya kaayo, is the kabaliktaran, syempre, it is wherein the greater the chance that the firm will be able to pay their or to meet their obligations. So next is the times interest earned ratio. So it is expressed by the formula terms interest earned is equal to income before interest and taxes all over interest expense. So creditors need to know whether a borrower can meet interest payments when they come due. The times interest ratio compares cash received from operators with cash paid for interest. So it measures interest payments. It measures how many times the firm earns the amount of interest it must pay during the year. So that ends my report. Hopefully you understand my report. So So, in conclusion, financial statement analysis is composed of two, according to, diba, according to the techniques or primary techniques of the entrepreneurial financial managers, diba, there are two ways on how they can analyze the venture's financial statement. First is the break-even analysis and ratio analysis. So under break-even analysis, we have two subtopics in there wherein it is called the profit break-even and the cash break-even. So on the other hand, ratio analysis is composed of four subtitles wherein liquidity ratio, activity ratio, profitability ratio, and lastly is the debt ratio. That will be all. Thank you.
Good day to all of you. I am Alwin Sinadela, and I am here to introduce the topic about financial management. It is the continuation of the topic financial analysis, wherein it introduced the function of a financial manager. So here, the financial manager is bound to do the financial management. So let's define what it is. So it is the maintaining the proper flow of funds into and out of the venture, and it manages the use of funds and find the appropriate sources of funds as required, where it is work done by the financial manager. So with the financial manager, he is also bound to estimate the ventures following. So performing his duties, the financial manager has to estimate the business startup cost, manage its working capital, develop capital budgets, and last, develop appropriate financial controls. So let's define every factors that the financial manager should estimate on the business. So first, the startup cost. So it is an it insufficient if if there is insufficient capital. It is a problem whether it's a small business or a large company. It can be projected and managed by creating a startup budget. So it basically means that even if on small business or a large company, with failing plan to accommodate the startup cost or the new startup cost, or when you are starting the business and you don't know what really is the cost, then you can probably fail in venturing these businesses. So the next one is the working capital. It represents the amount of capital available for the day-to-day running of the firm. Sufficient working capital is obviously important. So why is it important? Um, uh, Sufficient working capital is important because from managing these assets that the business have, the financial manager should just concentrate on the three following, which is the cash, accounts receivable, and inventory. So with the cash, the financial manager should able to flow it continuously and don't need to left idle, because with that, stagnant, the money will be stagnant if the flow of money is interrupted. That's why the working capital should be sufficient. So the next one is the accounts receivable. So these are the really promises of cash from customers of the firm. Until this cash is in hand, the firm has the only promise. So what does this mean? These accounts receivable are obviously the money that the business should be receiving. So in managing accounts receivable, the financial manager. So let's proceed to the next slide. The financial manager should be able to. So these are the um, obligations of the financial manager. So he needs to speed up the collection of accounts receivable as much as possible, since as defined in the working capital, the flow of money should always be not left on idle or stop or stagnant. That's what I said. So the next one is the needs to date. He needs to date accounts receivable. So he needs to not left the calendar be due because of these accounts or customers that did not pay. And lastly, you need to speed up the conversion of received payments into cash in the company's account. So every business have its own account for their business. So this financial manager should um, be able to cash in on that bank account. They will have to receive the money, they should hastily put it to run the money, not on idle, because as we know that the bank gives a certain interest by storing your money on the account. So this business also use the used to receive money by having the credit, by the payment for the from the customers credit cards. So they are eligible to have these perks, or ano yan, they have the right to have these merchant accounts on banks in for them to be able to receive money through these credit cards. So with this they are given like 3 to 5 they are obliged to give 3 to 5% of the um, payment from the credit that the customer gave. So that's why we observe that these credits have interest that they charge for you. So let's move. Um, the credit and collections. So the business must develop credit and collections policies, and it must execute those policies consistently to maximize revenue. So a collection policy should be established. What does it mean? So as credit and collections, the store can produce credits for the customer to be able to give loans for these customers that cannot pay directly with the amount of what they want from your business. So with that, um, certain time frames are given to collect this money. So that's why a collection policy should be established. So next slide. These receivables exist because of payment terms. As what I've said, there are certain time frames that the money should be collected. So credit terms are quoted in a variety of ways, such as net 10, net 30, 2% in 10 days, net 30. So what does it mean? So with the net 10, they are given like about 10 days to pay directly with the invoice of the product that they acquired from you. With the net 30, it's about 30 days. But in this last option, they're given about 2% in 10 days, and then pay the rest of the remaining balance in the next 30 days. They're given the time frame. So with that, the average actual collection period is known as days receivable and can be calculated as follows. So these are the following formula to know what if you are not lugi in the business. So days receivable is equals to actual accounts receivable over sales per day, where actual accounts receivable is equals to average levels of receivables on the balance sheet during the period being evaluated. And last, sales per day is equals to annual sales over 360. So your annual, like yearly. So the next. So precautions are also made if the customer with the credit has not um, given the payment. So if no arrangements are made and there has been no response, then there are a few options. The first one is the pre-collect notice. So these are the notice that was sent by you from the agency to the debtor, which states that we are monitoring this account. Please make arrangement to pay or we'll take the account over. So this gives the motivation to the payer or the debtor to pay his debts. So the next one is if there's no option other, collection agency. So it is considered by law to be the third party collectors. This means they must follow state and federal laws in the collection of a debt. So one example of it is the Fair Debt Collection Practices Act or the FDCPA. So in some countries it is used to let the debtor be obliged to pay the debt they have in a certain company or a business. So the last one, if the customer will not pay, so it will be driven to the court. A legal debt collector. I mean, a legal debt collector may sue consumers for the purpose of obtaining court judgments for debts. So the business manager or the financial manager can sue these customers by not paying their debts. So despite this, the business should always retain the customers as client. So they need to be positive in collecting these debts because a customer gone is a profit gone, right? So let's move. Inventory management. So the business should have its stock available for its inventory as money should work. And inventory is an investment in future sales. So what does it mean is that um, the financial manager or their employees that are assigned for it in the inventory management should always keep on um, knowing the stocks for their inventory because some days if favorable these products are mm, sold rapidly, and a business should always project that there should be always a stock because people do like it. Just like an example, like in the Walmart, um they tend to hoard or in it not hoard um gather a lot of stocks during the Christmas season because people tend to buy a lot. um there are a lot of sales, so with that they have the stocks to give to the people and then be stagnant on January to February as sales are low on that months. So let's move. The purchase of capital assets. The business assets must be periodically replaced and upgraded, and as business increases additional assets may be required. So renovations or new equipment should be um, prioritized also by the business because sometimes these machines or equipments that are used tend to be faulty in long term. So business should invest on it. So with the receivables, so the capital assets should be purchased with the following equipments or the ones you're using to aid your business. So the next one is the payment of debt. It is the renovation and major purchases of a business can be done most of the time by borrowing money. The collection of money will aid in these purchases. So what does it mean that these businesses also borrow money? So with that, they are bound to always collect the money from the debts from the customer. So they need to also um, consider the payment of interest and principal on any outstanding debt as a use of funds, and needs to add this debt service in the calculation for funds usage. So it is not only the customer that has debts, but these venturers or these businesses also have, in order to have a major purchase on their um, new product lines if they want to have it. The next one is the payment of dividends. So these are payments made to the firm's shareholders as a form of earnings on their stocks. So this basically means that the owner is not the only shareholder for this business. So some other people also invest on some businesses that are attractive to people in order to gain profit. So with this help, it also aids the business or the financial manager in his position to um, also have the extra money to buy these major purchases. And lastly is the capital budgeting. Sorry. So it represents the funds allocated for future investment of the firm's cash. This may be plant expansion, equipment improvement, acquisitions, or other major expenditures. It involves comparing and evaluating alternative investments. So sometimes this capital budgeting, as the business grows, the profit is separated from the capital. So this capital budgeting should always roll or be not stagnant also. So with that, major purchases are also be purchased, and therefore benefits are difficult to gauge in advance. So sometimes then these capital budgeting with the purchases may also not work. So that is all that is given to this topic of financial management. So with that, thank you for listening, and goodbye.